Hello. Today we're looking at the Fidelity Special Situations Fund, and I'm delighted that Alex Wright, manager of the fund, has joined me. Alex, let's start with the UK market in which the Special Situations Fund invests. It's obviously been out of favour for a very long time. I wonder if you feel that that's been justified and what the outlook is now.
So you're right, Tom. Particularly over the last 5 years, the UK market has been out of favour. That really started back in late 15 as people started to worry about the upcoming EU referendum, and then obviously we had that shock result, and that has really been a drag on the UK market, along with other political worries, including the general election. And then actually with the COVID crisis last year, the UK was then particularly badly hit by that in terms of the effect on GDP. So there have been a lot of things at a macro level that have been worrying people and keeping them out of investing in the UK market, and have led to that poor performance. I think what's interesting, though, if you look at those two key things, clearly the Brexit and the leaving the EU has actually now occurred. So we avoided that no deal Brexit. We did get a deal, and the new relationship is now working its way through. And then also on the COVID front, we've clearly now had the vaccine news, and there's a very fast rollout of that vaccine in the UK. So actually things are really looking up from a macro perspective for the UK, because the market has had a long period of underperformance, long period of underinvestment, whereas the reasons for that are now in the rear view mirror. And so actually we've seen a very strong bounce in the UK market over the last 6 months. So just looking at the 6 months to the end of February 21, UK market's actually up over 15%. That's more than double the return of the S&P, which is only up about 7%. And indeed, the value part of the market has done particularly well. So special situations over that period is up about 22%. So yes, it's been a really tough time for value and the UK market, but that has quite dramatically turned around more recently.
Okay, so let's just pick up on that, because you're talking about the different styles of investment, value investing and growth investing. And this fund is very much a value focused fund, and that's been an investment style that's been out of favor for a long time now. What makes you think that that's changing?
So again, like the UK's been out of favour, value investing's been out of favour, and indeed probably longer than that 5 years, more like a 10 or 12-year period where growth has been in the ascendancy. And the reason for that is very lackluster global growth in GDP, and that's led to extremely low interest rates, which has really favoured growth stocks, and where the lowering of discount rates that are based off interest rates and bond yields has really favoured very long duration growth companies like the big technology companies in the US. Now, again, I think virus related, there is a potential that that's turning around, because indeed you've seen some quite big move up in interest rates at the long end in the US recently, with the US 10-year moving up. And that has started to contract some of the very high valuation multiples you're seeing in these growth equities and favouring value stocks. So again, it's been a long 10-year period, actually most of my fund management career, where growth's outperformed. There is really the potential now that we could be seeing a different regime with higher interest rates and higher nominal GDP growth as we exit the COVID-induced recession.
And I guess, related to the rising bond yields and potentially interest rates is the question of inflation. There's a lot of talk about inflation. I just wonder, do you think about that, and how does it influence the positioning of your portfolio?
So certainly there are some signs of inflation picking up, because indeed the big fiscal stimulus that the governments have applied globally because of COVID is feeding into quite strong consumer demand. And that's facing supply, which is constrained because firms cut back very dramatically when they first saw the lockdowns in Q2 last year. And again, it's still difficult to produce things. Things are slower. People aren't able to work at full efficiency because of safety measures. And I think that does mean we're likely to see a burst of inflation in 2021 at much higher levels than we've seen historically. There is a big question how long that continues for after that initial big demand supply mismatch. But I think, again, higher inflation with higher bond yields is generally good for value equities. So it would be good for my style. Obviously, you have to bear in mind, do the companies I'm investing in have pricing power? So that's certainly something I'm looking at across the portfolio to make sure my investments can live with a higher inflation world, being able to pass through that higher cost pressure that is certainly going to be a factor in 21 and could be more of a factor than it has been in the last 10 years in the next few years.
Okay, well, let's talk about your stock picking approach and the kinds of shares that you look for. I mean, I guess typically we've always thought of this fund as a kind of contrarian fund. Is that how you would describe yourself?
Yes, definitely. Like, I like looking at things that are unfashionable, that other investors aren't really excited about, because I think that if you're not in a fashionable sector, less people are looking at the sector. There's more chance of you getting an edge by doing the deep research there. So I particularly like complicated businesses and businesses where things have maybe been going wrong in the short term, but there's actually a good franchise. So that's what contrarian means to me. It's not buying bad companies, it's buying companies that people perceive as being bad today because of something which has clouded their judgment. So that's how I sort of see being a contrarian investor.
And in what sort of sectors or industries would you be finding those kinds of shares at the moment?
So I think an area that has always been a really good hunting ground for me has been the financial area. It's been an area that ever since the financial crisis, people have shied away from, because clearly banks were very much at the heart of that crisis. They're complicated businesses where regulators have obviously got very involved. But indeed, I think while there are issues with banks structurally, actually across financials, there's some very good companies that people have also steered away from. So we've had a big involvement there over the years. And today we're particularly focused on insurance and life insurance, which is about 15% of the fund, because these actually are very good companies. They really play into the positive change and the rebuilding agenda post-COVID in terms of their investment into long dated assets. So infrastructure investments, mixed use developments, build to rent projects, long-term assets that the UK sort of really needs, as well as a lot of green infrastructure. But yet they trade very much like banks on the same kind of sort of 7 to 9 times price to earnings multiples, incredibly low levels. So that's the kind of example of actually some really good companies that the market thinks are poor companies.
Okay, and just finally, Alex, and you sort of kind of touched on this a little bit, but I just wonder what sort of market conditions really suit your fund. I mean, when would you expect the fund to outperform, and when might you expect it not to do so well as other UK focused funds?
Yeah, so it's very much around there being change. And trends not just continuing as they've been. So the fund struggles when a very well-established trend just continues, because we're looking for things to change positively. So if the environment's just exactly the same as it has been for a long time, so a bit like we were seeing previously, pre the COVID crisis, that growth was just very lackluster, continued just investment in the same high multiple, high value, high dependability companies, a changing environment is good. So actually, I say right now, with the huge uncertainty that COVID's created, that's really exciting. Just like it was back in 2011 with the European banking crisis, that threw up some amazing opportunities as people effectively threw the baby out with the bathwater. So any environment where there's significant change, that's something I really like to see. An environment without significant change, a long-running trend, that would tend to favor more momentum strategies, and that's very much not what we're doing. It's an anti-momentum contrarian strategy.
Alex, thank you so much for those insights into the Special Situations Fund. And thank you for watching. Goodbye.